Have you ever thought you could outsmart the stock market? You're not alone. Many investors believe they can pick winning stocks and time their trades perfectly. But here's the shocking truth: over 80% of active fund managers fail to beat the market each year. Yes, you read that right, most professionals struggle to keep up with simple index funds. Consider this: if you had invested $10,000 in the S&P 500 in 1990, it would have grown to about $70,000 by 2020. In contrast, many active investors would have fallen behind during the same period. This gap is huge, and it raises a critical question: why do so many people think they can do better? In this video, we'll uncover the myths surrounding beating the market. We'll dive deep into hidden costs that eat into your returns, reveal the truth behind market predictions, and show you the power of compounding. By the end, you'll understand why embracing the market averages could be the smartest move you ever make. Stick around, and let's explore how to build real wealth without the gamble. Chapter 1. The myth of outsmarting the market. Many investors believe they can outsmart the market, but this idea is often a fantasy. In fact, studies show that about 90% of active fund managers underperform their benchmark over a 15-year period. Let that sink in. These are professionals with access to the best research, tools, and data, and most of them still can't beat the market. One big reason why is the efficient market hypothesis, EMH. This theory suggests that stock prices already reflect all available information. In other words, the moment you hear about a hot stock tip, the market has already priced it in. So, unless you have insider information, which is illegal, you're playing catch-up. Warren Buffett, one of the greatest value investors ever, agrees with this. He once said, by periodically investing in an index fund, the know-nothing investor can outperform most investment professionals. Think about that. Even Buffett, a master at picking individual stocks, admits the average person is better off sticking with the market rather than trying to beat it. But it's not just about access to information. Human psychology plays a huge role. Investors often fall victim to cognitive biases like overconfidence and herd mentality. Overconfidence leads you to believe you're better at picking stocks than you really are. Meanwhile, the herd mentality causes investors to follow the crowd, often buying high and selling low. Chapter 2. Hidden costs. The silent wealth killers. Even if you could beat the market, there are hidden costs that quietly drain your wealth. One major culprit is fees. A typical actively managed mutual fund charges around 1% to 2% in annual fees, which may not sound like much, but over time, it's a wealth killer. A 1% fee can reduce your total wealth by nearly 25% over 30 years, according to Vanguard. Taxes are another sneaky expense. Every time you buy or sell a stock, you could be hit with capital gains taxes. The more frequently you trade, the more taxes you pay. This eats into your returns, making it harder to outpace the market. In fact, tax-efficient investing can add up to 2% annually to your returns if done right. Inflation is another often ignored factor. Even if your portfolio grows by 7% annually, with 2% to 3% inflation, your real return is closer to 4% to 5%. These small percentages compound over time and can make a huge difference in your end balance. It's important to remember that you aren't just trying to beat the market, you're trying to beat the market after costs. Most investors don't realize how much these invisible costs reduce their actual returns. That's why passive investing strategies, like low-cost index funds, have become so popular. They remove most of these hidden expenses. Chapter 3. The mirage of hot stocks and market timing. Many investors think they can beat the market by finding the next hot stock or by timing the market just right. But the truth is, this approach is closer to gambling than investing. A study by Dalbar Inc. found that over a 30-year period, the average stock investor earned only 3.7% per year, while the S&P 500 returned over 10% annually during the same time. The reason? Investors consistently bought high and sold low, chasing trends and panicking during downturns. Timing the market is notoriously difficult. Missing just the 10 best days in the stock market over a 20-year period could cut your returns in half, according to J.P. Morgan. These best days often come right after the worst days, which means if you sell during a crash, you're likely to miss the recovery. Hot stocks are equally tricky. For example, in 2000, everyone wanted a piece of tech companies. Then the dot-com bubble burst, and many of those can't-miss stocks evaporated overnight. Even today, hot stocks can crash unexpectedly. In 2021, shares of Zoom surged during the pandemic, only to fall by over 70% from its peak a year later. The lesson here is simple. Chasing trends and timing the market is a losing strategy for most people. Even professional investors often fail to get it right. According to Spiva reports, 80% of active U.S. equity funds underperformed the S&P 500 over a 5-year period. That's why many successful investors focus on long-term strategies like value investing rather than trying to predict short-term moves. If you're finding value in this content, don't forget to subscribe to our channel. Join our community for more insights into smart investing strategies. Chapter 4. The Illusion of Control. Why market predictions fail. Everyone loves a good prediction, especially when it comes from so-called experts. But the truth is, market predictions fail more often than they succeed. In fact, a study by CXO Advisory Group found that experts were only right about 47% of the time, basically a coin flip. Even the smartest analysts can't consistently predict the stock market because of the sheer number of variables at play. One reason for this is what psychologists call the illusion of control. Investors often believe they can control or predict market outcomes, but the reality is far more chaotic. Stock prices fluctuate based on everything from corporate earnings to unpredictable geopolitical events. No one, not even the most skilled investor, can account for all these factors. Take 2016 as an example. After the Brexit vote, many experts predicted a market crash. Instead, the market rallied. In the same year, the US election shocked everyone with unexpected results, but the market kept climbing. These examples prove just how unreliable predictions can be. Legendary investor Benjamin Graham, author of The Intelligent Investor, had it right. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. What this means is that short-term market movements are driven by emotions and speculation, while long-term results depend on fundamentals like earnings and growth. The lesson? Ignore short-term predictions. Trying to predict where the market will go in the next few months or even the next year is a fool's errand. Instead, focus on long-term strategies that are grounded in solid fundamentals. This is why value investing has stood the test of time. It's based on the inherent value of a company, not on guessing where the market will go next. Chapter 5. Compounding. The true secret to wealth. If you ask most successful investors what the real secret to wealth is, they'll likely tell you it's not flashy stock picks or market timing, it's compounding. Compounding is simple but powerful. When your investments earn returns, those returns also start earning returns. Over time, this process snowballs. Albert Einstein once called compounding the eighth wonder of the world. And for good reason. Here's a quick example. If you invest $10,000 at a 7% annual return, after 10 years, you'll have around $19,672. But after 30 years, that $10,000 turns into $76,123. The longer you invest, the more the compounding effect accelerates your wealth. What's crucial is patience. Value investing embraces compounding because it's a strategy designed to grow slowly but steadily. Warren Buffett's personal fortune is a testament to this. Most of his wealth came after he turned 50 because of the incredible power of compounding. He famously said, "The stock market is designed to transfer money from the active to the patient." One thing to remember with compounding: time is your greatest ally. The earlier you start, the more time your investments have to grow. Even small amounts can become significant over time. For instance, investing just $200 a month in an index fund with an average return of 7% can grow to over $240,000 in 30 years. The key is consistency. This is why long-term strategies like value investing or investing in low-cost index funds are effective. They allow you to let your money work for you, rather than constantly trying to outsmart the market. Compounding is the ultimate set-it-and-forget-it strategy, and it's one of the few guarantees in investing. If you enjoyed this video and found the insights helpful, please subscribe to our channel for more tips and strategies on smart investing. Join us as we continue to explore the world of finance and help you become a more informed investor.